Welcome to the Ag Commodity Corner Plus. It's Friday, May 9th. It's about 3:30 in the afternoon. And my name is Mo Agostino, Chief Commodity Strategist with Farms.com Risk Management. We got Avinash Global with us here today as well. And today's title is the U.S. fast planting pace, and talk of 97 million acres is weighing on corn futures, while a UK trade deal and talks with China this weekend are brightening that economic growth outlook. So there's a lot of other things that happen this week. We'll try to provide you with the top events and news that were driving markets up or down. So just to start off with the summary weekly market quotes, you can see corn was down 19 cents, but we're off about 50 cents from the highs, those early February highs. We had cattle and feeders go to new record highs again. We'll get into that a little bit later. Bitcoin was breaking back above 100,000, and gold, even though it was up this week, it's come off from the highs. And my sense is that since those April anxiety highs, we've turned into this more optimistic, more hopeful of trade deals because Trump announced the UK trade deal. So I think the funds are flowing, the capital from ag and gold back into risky assets like Bitcoin and stocks. Okay, let's start off with that U.S. fast planting pace in the U.S. on corn.
Well, Mo, we have a wide array of topics to cover this week. Let's, like you said, start with the U.S. Planning pace. So, like you were saying, there's trade talk of the U.S. acreage for this year coming in closer to 97 versus the March intentions, which were at 95.3. And this is owing to a fast planning pace, and weather is a non-story as of now. We've had a wide open planning window, which is resulting in expectations of 97 million acres. And this is also weighing on corn futures. Soybeans, on the other hand, it looks like soybean acreage should be closer to March intentions, which are at 83.5 million.
You can see on that chart, the last time we were at 97 million was 2012, which was another dry year. The Western Corn Belt's dry, but the East is wet, particularly the South and the Ohio River Valley. And that area, the South and Ohio River Valley, is expected to stay wet through the second half of May. And you can see the corn chart, that February high, and then we had that April high, and we're off about 50 cents from the April high. So from here on in, it can go either way. There's a bunch of seasonals that happen this time of the year, but this is an odd year because of U.S. tariffs. So we'll see whether we can kick in a seasonal rise in corn prices. I think the market is worried about the potential for 97 million. Remember, on Monday's report, USDA May crop report, you're not going to see 97. You're going to see that 95.3. It's not till the end of June acreage report, you'll see the 97 perhaps printed. So that could be very bearish corn. And I think the market's also thinking that we have strong corn yields because of this fast planting pace. And of course, with the soybeans, if we're going to add acres to corn, we could subtract acres to beans. Again, that won't happen until the end of June, and therefore that's why bean prices have been range bound and pretty resilient thus far.
Mo, let's from corn and soybeans, let's jump into crude oil futures. And towards the end of that chart, as you can see, this week's been better off versus last week. So we've got June crude oil trading closer to 60.95 versus last week when we closed at 58.41. Fundamentally, OPEC decided to increase crude oil production output in June and is committed to fighting a market share war with the US.
If you get a weekly close like last week below that 58.93, that's bearish. But this chart is showing me that we're maybe creating a double bottom, and you could maybe retest that long-term support at 65. So the Saudis are committed to this grind, this lower market share grind over time. So as we get into the summer driving season, if we're going to start announcing more trade deals, I think we may have bottomed short term. So we'll see what happens going into next week.
This week also, Mo, we had the US Fed FOMC for May, and they left interest rates unchanged. Excuse me. And looks like for the next FOMC as well, it looks like they're going to leave it unchanged. And this is a lot owing to the uncertainty over US tariffs.
This is CME Fed Watch chart. It's showing you that the first cut may be in July, and I think it's 51%. It was around 53%. So the Fed may not actually cut at all this year, depending on how that data turns out over the next couple months. I don't think we need to talk recession anymore in the US in every conversation we have, but we could be seeing slower growth as those tariffs take effect.
This week we also had legendary investor and financial markets leader Warren Buffett announce his retirement. And as those charts show, if since 1964, if anyone had invested in Berkshire Hathaway shares, you would have seen a rate of return of 5.5 million%. And this compares to the S&P 500 index over the same period at 39,000% more.
What an amazing return. If you got lucky and you did invest with Warren Buffett over these years, congratulations. What can I say? I knew about it. I never did actually invest in it, so I'm a little upset about that, but I don't know if there's ever going to be another guy like him. There's a bunch of hedge funds around the world that actually track what he does, to try to mimic what he does, and they've done actually quite well. We're going to miss him.
So let's talk about the US consumer and their relation with the economy. So don't bet against the US consumer. Despite recent economic uncertainty, a resilient US consumer and economy means slower economic growth due to tariffs, but possibly not a recession.
I've said this a million times. Never bet against that US consumer. The minute you think that economy is going to come under pressure, maybe go into a recession or depression, they seem to always pull it out. Remember that US consumer spends $20 trillion a year. That is why China needs the US. I don't know if one needs one or the other more, but that's why the globe needs to do some trade deals with the US. It's the largest consumer in the world, and over the last month, the markets have talked about exceptionalism. That word basically refers to the US market is the best in the world, the economy is the best house in a bad neighborhood. They create a lot of innovation, disruptive technology, all that fun stuff. So that is one reason why the Dow's back up again, S&P and NASDAQ from those liberation lows. And, you know, this time of the year, there's an old saying, sell in May and go away. The period between May and October can be a lot rougher than the period between November and April in terms of performance. So we'll have to wait and see. This is an odd year because of U.S. Trump tariffs. If he continues to announce a bunch of tariffs, if we can get something going with China, I think this period between May and October could actually outperform.
Talking about the economy and also linking that to the stock market, US will lift chip export restrictions that were to take place on May 15, which opens the Chinese market to AI. So as we had seen previously, some of that trade uncertainty was weighing on stocks, and especially the tech and AI stocks. This is considered to be a huge win for NVIDIA, the US, and also the AI race. There's no evidence of any AI demand slowdown because of tariffs yet.
AMD reported their earnings, and there was no tariff in their conference call. I don't think NVIDIA on May 26 will report tariffs in their conference call, but you can see from this chart we're up 36% from the liberation lows. So when you have quality companies like NVIDIA for sale because of some macro event like US tariffs, it's a buying opportunity. So again, we provide a daily premium report to our clients. In this week's reports, we talked about the seasonal grain highs, what to do with crude oil below 60, and how low can wheat go. So sign up for free. You got nothing to lose. Join the program and let us teach you how to be a better marketer.
Some more good news this week on the trade front. So this week the U.S. struck a trade deal with the U.K., and this actually is the first agreement that this Trump administration has reached since Trump announced sweeping tariffs. So as per the current specifics of the deal, UK will reduce non-tariff barriers to US beef, ethanol, machinery, chemicals, among others. But the 10% US baseline tariff remains. This looks like it'll go a long way towards healing fund sentiment near term.
I don't understand why there's a 10% across the board tariff. But I've warned everybody that Trump wants to maintain a tariff around the world. At the end of his 4-year term, if he had a 50% tariff, it'd be a win for him. So, in a trade deal, I'm thinking you should reduce the tariffs, not increase them. But anyways, this doesn't move the needle much for the U.S. because although UK was the second largest ethanol importer, second only to Canada, and I don't think it moves much the needle on beef because they were ranked very high. So I'd be more concerned with Mexico and China.
Let's talk about the cattle market. Among the ag commodities, the cattle market's been climbing to new record highs and yet to hit resistance. New record all-time highs again this week on cattle due to strong cash demand and a lack of supplies.
That slaughter in cattle is averaging a minus 7.7%. That compares to hogs at minus 2.5%. That is why you keep going to new record highs. Because we haven't rationed demand, in other words, that U.S. consumers still buying beef at record highs, until they start saying no to these high prices, we will not hit a top. There is no end in sight. Technically, this thing's going higher.
We also had the Stats Canada March the stocks report as per March 31, 2025, and as you can see there in that chart, a lot of those numbers came in lower year on year, but possibly slightly higher than expected. More supplies than expected, suggest Stats Canada was underestimating last year's canola crop by 1 to 1.5 million metric tons.
So that canola at 5.4 actually came in lower than the estimates of 5.8%. Even though we may have produced more last year, we need it because we're running out of canola bushels, period. So I still think that canola futures, we've talked about this over the last couple of weeks, it needs to ration demand with higher futures.
The big news for next week, and also what the market has been waiting for, is the USDA May crop report, and as we all know, that is when we'll get the first look at the new crop, U.S. new crop and world balance sheets. This could be bearish new crop prices, as USDA is expected to factor in the U.S. tariff policy, and due to that, demand could be revised lower. But the big question is this already baked into futures?
So they're expecting $2 billion in new crop corn ending stocks in the U.S., 380 on the beans. Our concern is that if the U.S. is going to take into account these new U.S. tariff policies, do they revise demand lower? If they do, that 2.0 billion in corn comes in higher. So do beans. There's some estimates as high as 550 in beans. That would be very bearish for beans and of course corn. Let's end with CFTC.
The funds have been exiting long positions in corn, especially the old crop contracts, with the anticipation of much larger new crop ending stocks in the May USDA for next week. As of 29th April, managed money funds were long over 71,000 corn contracts, 38,000 soybeans, 66,000 canola, but in the wheats they are still massively short.
In real time, after this week's lower corn trade, I would assume that the funds are flat. They're no longer long. They're very bearish week because even today both Chicago and Kansas hit new contract lows, and so it'll be interesting to see what happens next week. On Sunday night, the headlines from China, U.S. trade talk in Geneva is going to move markets, as is the USDA crop report on Monday. So Monday is going to be a very important day. I would not want to be short these markets going into the weekend. Thank you for watching. Don't forget to sign up to our program. It's absolutely free. You got nothing to lose, and you'll gain a ton of insight. Until next time, thanks for watching, and happy Mother's Day to all the mothers out there.